Hello everyone and welcome to our latest BKL tax webinar. Today we're going to be covering BPR or business property relief changes with a delicate seasoning of APR thrown in just to see how we all get on with that as well. So I'm Anthony Newgrosh. It's good to be back with you. I'm delighted and somewhat relieved to be joined by two experts in the field. Can I first of all introduce to you Ryan Bevan, who's our head of IHT Trust and Estates. Hello Ryan.
Hello all. Yes, so my name's Ryan. I cover all areas of UK and international trusts, inheritance tax planning, estates and probate.
Okay, and Ryan also heads up our new Cardiff office, don't you, Ryan?
I do, yes. So we've got fresh new office opening in Cardiff this month. So if you're in the Cardiff or Bristol areas or anywhere in Wales, do let me know. It'd be great to catch up with you.
All right, thank you, Ryan. I'm delighted also to be joined by Susie Mullin. Hello, Susie.
Hi, Tony. So I'm Susie. I'm a private client partner. Predominantly, I advise business owners, often with regard to BPR, but also with relation to sales and all sorts of things that goes with business ownership from sort of the beginning to the end of that life cycle. Great to be here.
So both relatively new to BKL, so welcome to BKL and welcome to the webinar. Okay, so what are we going to be covering today? So we will look at the current BPR and APR rules, focusing very much on BPR. We'll then talk you through some of the proposed changes, where that leaves us, the planning opportunities. Ryan's going to give us a heads up as to how trusts can help, a few other points we'd like to throw into the mix. And obviously we do invite and welcome your questions. You should have a little chat box at the top of your screen. We're using slightly different software to last time, so it might look a little different for you as well as us. But there is a Q&A box there. Feel free to type away your questions. We'll try and pick them up as we go along if we can. We may pick them up at the end, or apologies if we don't have time. We will also be sending you both a copy of the slides and the link to this webinar, so you can listen to it all over again if you so wish. And if there are any questions we feel are of general interest and we haven't covered during the webinar, then we will send those answers there. So do please let us have your questions, thoughts and comments. But if you'll forgive the indulgence, just a couple of words about BKL. Oh, you know us now, we're like old friends, aren't we? So we're now, well, I think considerably over 400 people. It says there, we've got office in North London where we are today, Susie. We've got one in the City of London, and as Ryan mentioned, we've now also got an office in Cardiff. So we've gone international. We're a top 40 accountancy firm. We're a B Corp, and we're part of DFK International, our international network, so we can ensure you get not just UK advice, but international advice as well. So that's a few words about BKL. And, well, in true sort of Manchester City style, they're a football team, Susie. Modesty precludes us from talking about all the awards we've received. But just to mention, we are now in Chambers High Net Worth Guide as a leading firm. And congratulations to Sam, Fabio and Alex. We've got 3 nominees in the under 35 Accountancy Age Awards, which I think is a brilliant achievement. So well done to all of them. I just missed out by a matter of months, I believe, but you never know, maybe next time. So that's a little about us. If you need to know more or you need some technical information, there's plenty on our website, be it recordings and slides from our previous webinars. There's lots of videos, advice from our trust specialists and tax as a whole. And there's a couple of our colleagues, Anne and Stephen, having a little fireside chat. So they'd be happy to explain to you all about employee benefits on their previous video recording as well. So let's crack on. I want to start by looking at what are the current rules for BPR and IHT and APR, we should say. So, Susie, I think it's over to you to take it away.
Right, thanks, Tony. So just to start with where we are today, and I think where we are today, I think we can all now safely say with the changes that we're in a really good place until April 2026. So at the moment, that means for 100%, so business property relief, which is a very, very valuable relief for business owners, entrepreneurs. So currently there is 100% relief from inheritance tax for individuals owning a business or an interest in a business. So that would include a partnership interest, shares in an unlisted company, including currently shares listed on AIMS, and also some unquoted securities in companies, that being not shares. So where the company is controlled by the individual in question. There's slightly less generous relief, so 50% relief for inheritance tax for shares in a quoted trading company that an individual controls. Quite a rare relief to see, to be honest. And then also for land, buildings and machinery owned personally but used in a qualifying business. There's lots of conditions that come with that BPR relief. One of the key ones is that the company must be, and the legislation talks about not wholly or mainly investing in certain things, including property and shares, holding of stocks and shares. So it must, we tend to say wholly or mainly trading, so wholly or mainly carrying out a trading activity. And then the asset in question is, so shares, for example, or a business must be owned for at least 2 years in order to qualify for business property relief. It applies to UK businesses and non-UK businesses, and then I'll talk a little bit more on the next slide about the sort of accepted assets and excluded subsidiaries. So just digging a bit more into the relief. As I mentioned, it's for trading or non-trading, and that is a wholly or mainly test. So it's a 50% test. So it's not a hugely difficult test necessarily to meet in the first instance.
I was going to ask you, are there any excluded trades for these purposes?
Well, it depends what you mean by trades. The predominant one that we see, and we're talking to lots of clients about now, is property.
Yes.
And if we talk about property, there's a different concept from a tax perspective, really, to property investment, which is holding property, which generates income for you, such as rental properties, and then property development, which is a trade. And so for lots of our clients who are in property investment, they won't qualify for business property relief. But as I said, it's a 50% trading test. So lots of people on the face of it will meet that 50% trading test. And it's there isn't one test. So you look at a number of tests. You look at, for example, you look at profit, you look at gross assets of the business, you will look at employee time. So it's a holistic test when you look at the business. And for many businesses, they will meet that 50% test in the first instance. It includes shares in holding companies of trading groups. So if you were to look at the legislation, it would tell you that holding stocks and shares is not a qualifying trading activity, but it is if you're a holding company of a trading group, that would qualify for business property relief. The challenge that arises for business property relief, particularly in family businesses or sort of very tightly held private businesses, is not the 50% trading test, which is often quite easy to sort of get across. It's the fact that there are other things in the business that might not be used in the trade. So there is the concept of accepted assets in this legislation, which is to say that the relief will be restricted where you have these accepted assets. So that might be, for example, and accepted assets, just to explain, is essentially assets not used wholly or ordinarily in the business, either currently or being held for future use for the business. So often things that we see as a problem, as on the slides, is cash, where people hold more cash than they might need for the ongoing needs of the business. So things that you need, for example, for working capital should obviously qualify for business property. They won't be excluded. But lots of businesses will hold a lot of cash, and that might not therefore be a qualifying asset. It might be accepted. And then also property not used in the business. So we see lots of our clients, particularly growing businesses, for example, who will have one property and they might then buy a bigger property, but they might keep the smaller property. That property obviously isn't used in the business anymore. That they might lease that property to somebody else, but keep it. That then is not used in the business and therefore may be an accepted asset. So this 50% test, as I mentioned, might be quite easy to pass, but you might then end up with lots of assets that are accepted, such that even if you do qualify for business property relief, it is restricted. One of the things that's noted on the slide is this concept of a hybrid business, because there is a slightly strange concept that doesn't exist necessarily in other bits of the tax legislation, where if you've got a business which is wholly or mainly trading, so let's say 70% trading, but let's say 30% might be property investment, let's say, that itself might be a business. So you might say, well, this is actually a business. I lease those properties to someone else. I carry out an active business. I manage that property portfolio. That might actually constitute a hybrid business. And oddly, and it's definitely something to take advice on, oddly, that might then all qualify for business property relief. So definitely advice needed as to whether you qualify for business property relief and whether you have some exceptions. just noted on here is that sometimes we get to the point where you've just got too much that's not trading in the business, and we talk to people about restructuring, so perhaps demerging or taking assets out of the business that would prevent you from qualifying for business property relief. And then sometimes when we're giving advice, often it's not super clear, to be honest with you, whether or not you do qualify for business property relief, and you can apply for clearance from the revenue if there is sufficient uncertainty. So we're doing that for lots of our clients at the moment for reasons that'll become obvious in a minute, I think.
Okay, I take it that's a non-statutory clearance, is it? So it's for the revenue. They don't have to respond, do they, I guess, but they normally do, don't they?
They do respond. Often the pushback is they don't think it's sufficiently lacking, it's not sufficiently unclear, which you probably take to mean the answer is positive. But yeah, so they sometimes can be unhelpful, but often they're very helpful, actually.
All right, so thank you, Susie. So that's a quick tour of the existing BPR reliefs. And the key point is, at the moment, if you get 100% relief, there's no limit on it. So you can be in a very fortunate position where significant, huge chunks of your estate fall out of IHT, but we'll see how those changes will apply.
And I would just say politically, the reason for that, just to say though, is obviously so that business can be passed to your family free of inheritance tax, which isn't necessarily fortunate. It stops an unfair burden being placed on business being passed through the family, I would say, just to argue with you slightly there. But yeah.
I wasn't arguing. We don't do politics here,
sorry.
Susie, so that's okay.
Yeah.
But okay. I mean, talking of which, unfortunately, we couldn't get Jeremy Clarkson on today. So, Ryan, I'm going to hand over to you to talk about just very quickly about agricultural property relief.
Yeah, no, thanks for that. And yeah, it's similar to Jeremy Clarkson. I am quite passionate about farming. I'm from a farming background myself, and this is something that I'm passionate about. That's probably where the similarity ends, thankfully. So where we are currently, so you're going to get 100% relief from IHT for land, buildings and assets that are personally farmed. Land which is used by someone else on a short-term grazing licence. Land or buildings let on a tenancy that began on or after the 1st of September 1995. Which there's very few now that don't meet that sort of that condition, but there are still a few old leases out there. And there's a separate condition for property owned pre 10th of March 1981, which again is very obscure condition. But if you're in that position and you need some advice on it, do let us know on that. So 50%. There's only one circumstance where 50% relief will apply, and that is for land letted on a tenancy that began before the 1st of September 1995. As I say, don't come across that very often. It is still in the legislation. And so if there is land in that condition, then again, you may need to look at that and how you can restructure the tenancy that might mean it qualifies for 100% relief. So the key conditions, it is owned and occupied for agricultural purposes for 2 years if used personally. It's owned and occupied for agricultural purposes for 7 years if used by someone else. So that's if you're letting it for grazing or there's a tenancy involved. It only applies to the agricultural value, and it must be part of a working farm in the UK. So the agricultural value is quite an important point because there's a lot of farmland has development potential. So the development value will not qualify for agricultural property relief, but it may qualify for business property relief, again, depending on the conditions of who actually owns and uses the land. But essentially, if the land is used in a partnership, you may only get 50% BPR on the developmental value. And in certain circumstances, the development value can be far in excess of the agricultural value. So again, if you've ever got insertings on this, there's a lot of very good valuers out there that do split out the agricultural value and business development value on the land. So please do get in touch with us or a valuer if you do need advice on that.
Okay, Ryan, look, again, I know we don't do politics here, but there's, I guess, been an undercurrent that perhaps APR has been abused in the past. Is that a fair comment, do you think?
Well, yes, I think there was a lot of cases of rich people buying up land, then letting it, as long as they live 7 years, then that qualifies for APR. So they're not genuine farmers. They are land owners. Whereas if it was property they were doing that for, then they wouldn't get any IHT relief on it. So I think that was one of the reasons it's been brought in. I don't think it's been brought in the best way. There's lots of other ways this could have potentially been done, which means that genuine farmers still qualify for 100% relief, whereas people who are buying it just purely for an inheritance tax planning point of view, they would then not get the relief for them. Whether that's there is there is certainly the NFU have written to the government on this and have expressed their views on it. Whether anything will come about from that as part of the consultation period, which we'll come on to in a bit, who knows? But hopefully there's going to be some listening to farmers on this. And I say this is something I am obviously quite passionate about, being from farming background myself.
Okay, thank you, Mr. Clarkson. Right, so that's kind of where we are at the moment. Ryan, do you want to just highlight the timeline here we've set out and just talk us through this as to how these changes are progressing and when we might see some real action, as it were?
Yeah, so the first major part was for 30th of October last year. It's nearly a year ago now that we had the budget and these changes were announced. And of course, we had a lot of protests around London, lots of tractors driving around London just shortly after that. There was then a consultation period, a technical consultation period on the effect of transfers into trust and lifetime transfers. That ended on the 23rd of April 25. And on the 21st of July, we finally got to see some draft legislation. So the draft legislation was published, and that's part of what we're basing this webinar on, is the draft legislation. Then there was a further consultation period that ended on the 15th of September. And now there's been the Finance Bill Subcommittee of call for evidence trend, and I know a lot of professional organisations have written to this committee expressing how they think it should be enacted. So when we're going to get final legislation, that is going to be the big question. It needs to go through various readings, changes from the Houses of Parliament, the Houses of Lord, and it's going to come in potentially from the 6th of April, assuming there's no changes and it all gets enacted fine. That's when we're expecting it in, but we may not get legislation until late March. I mean, if for reference, last year's legislation, I think it was around about the 24th, 25th of March that the actual legislation was signed off, that came into effect from the 5th of April 25.
Okay, so really not that long away, is it, when you think about it? Here we are in October 2025 already. Blimey. Okay, and Ryan, do you want to just highlight some other changes in the legislation that, although connected, we're not going to deal with today, unfortunately?
Yeah, so the other bits of the legislation, there was a lot of legislation released on the 21st of July. And there's lots of it was not relevant for tax, but the other bits are, there's IHT on pensions. Again, that's on the consultation period. PICES, which again is more of Susie's interest rather than mine on that. Carried interest. Again, we've got specialties in that, if that's something that you're concerned about. Employee ownership, employee car ownership schemes, and umbrella companies, which I know umbrella companies has been a bane of a lot of our existence for a long time. So there has been some legislation on that. So again, if any of these things may affect you, please do get in touch with one of our specialists on that.
Yeah, I mean, IHT on pensions, I think, is a very significant point. And again, that's something we can help on, isn't it, Ryan?
It is. Now, we have got a bit more time on that. It's April 27. Any changes are likely to come in on that. And I know there's been, again, a lot of worry about how that's going to affect people, especially potential double tax charges on death, where you're going to have an inheritance tax charge and an income tax charge. So there may be changes on that, but we'll have to wait and see on that one.
Okay, and there is further information on our website, or speak to your BKL regular contact if you'd like any assistance on any of those matters. But as I say, that's perhaps for another time. So let's move on. Oh, too far, as always. Ryan, give us a quick overview as to the changes we can expect.
Yeah, so these are from the draft legislation. There's been no major changes to the core qualifying conditions. So what we talked about earlier in the webinar, those conditions, there's no changes to those conditions. So that's the bit of whether you actually meet the qualifications for BPR APR. The major difference is there's a £1 million cap on combined APR and BPR at 100% relief. So the unused allowance, unlike a lot of the other inheritance tax allowances, cannot be transferred to your spouse or civil partner. So if you don't use it, if all your assets pass to your spouse on your death, and you had business property qualifying assets, then they will only get their own £1 million allowance on their death. So you may need to think about planning and restructuring of how that would work best to capitalise as much as you can on the available allowances. If the BPR APR asset exceeds 1 million, then there's a 50% relief applies once you go above that 1 million cap. So it's effective. It's an IHT rate of 20% as opposed to 40% on assets over that value. So the relief for AIM shares is restricted to 50%. and not included at all in the 100% relief. So again, if you've got AIM shares, you're going to get no 100% relief on those shares at all, unless of course it meets other conditions that that you own them personally and it's your trading business, that sort of thing. But in general, if you've acquired them through the AIM market, then you only get 50% relief on them. IHT can be paid in 10 equal installments, and that would be interest free. So that is one major good point on this. And currently, you can pay IHT on certain assets over 10 equal installments, but it's at the HMRC interest rate, which is, I think, is about 7.75% at the moment.
It's pretty steep, isn't it? Whatever it is these days, it's gone up significantly.
So yes, you can pay it over 10 equal installments. It does help a bit with your funding of how you sort of plan that. So that is one of the major benefits of it. And the APR is extended to land withdrawn from agricultural use under qualifying environmental management agreement. So what that means, there's been a lot of things from government about farmers using land for woodlands, for meadows, and part of, obviously, if you remove the land to use it for that, you qualify for additional subsidies, but that means you're not farming the land. But there has been an exception put in the legislation that means that if you do use the land for that, then you can still get the APR on that land. Where you can't get is if you're using the land for solar panels or wind farms, anything like that, which is not under this. That comes under separate. Again, you may meet the BPR, but it's quite unlikely you would meet BPR conditions on that. So again, if you have got farmland which is being used for solar panels, then you need to consider how that's going to affect your APR claim.
Okay. All right. Thanks, Ryan. So the headline is really that £1 million cap on the combined APR and BPR. That's the problem. Just sort of put this in context for us. Oh, there you go, Ryan. Put it in context for us.
Yeah, so this is a recent piece of advice I was involved with. I've changed things a little bit to sort of protect our clients. So it's but the basis is, say you've got a trading company that's worth 15 million owned by a single shareholder, and if they die before the 6th of April 26, there'll be no inheritance tax due. If they die after the 6th of April 26 and without any planning or without doing anything, then there's going to be 2.8 million of IHT due.
That's quite a hit, isn't it?
That's a big difference, especially for a lot of trading businesses. That where are they going to get those funds from? Because ultimately that might mean a family business that's been created for trading purposes, been built up by the founder. The executors may have no choice but to actually liquidate that company just to get the value out of it to pay the IHT, depending on family circumstances and such on that. So what they can do, they can defer and pay it over 10 equal installments, but the executors will still need to find 280,000 per year to pay the IHT. Now, depending on the other assets, yes, the companies can pay dividends, but of course the executors will have to pay tax on those dividends. So it's not just the 280,000 if it's coming via a dividend payment. It would be more than that to take into account the tax being paid by the executors, and of course then the beneficiaries of the state will have to pay tax on those dividends as well. So there's additional complications of this one in particular was there'd been over £1 million of cash in the business, and having spoken to the owner, he's keeping it for a future project. But when we sort of drilled down more into that, it was actually genuine being kept because they were looking at buying a large warehouse for the business, which would have qualified for trade-in, but there's no actual documentation of that. So again, if you have got cash that you're using and you need it for a genuine business reason, it's important to document that in the minutes, because that's what HMRC will ask to look at if they challenge your BPR on death, is what evidence have you got that cash was being used for genuine business purposes, was being earmarked for trading, and it needs to be properly documented. It's not just 500,000 in case of a liability or something like that. It needs to be properly documented of what you're using it for. So again, if you are in that situation, again, we can help on that. We can look at it. We can help make sure you've got the documentation in place. We can actually take a devil's advocate approach as well and pretend that we are going to inquire into it and put you through the paces of how you can actually get that to qualify as a business asset. So yeah, please do consider that if you're in that position.
Okay.
So obviously the position we're in currently with that is that he can't just give away all his assets and make a pet now, which would qualify for 100% BPR, because he would have had to have done that before the 30th of October. He can still do it. He can still give it away now, but he would need to live 7 years for it to be fully exempt from IHT. Whereas if he'd done it before the 30th of October, he wouldn't have needed to live for the 7 years, as long as the asset was still held at the date of death.
Okay. Susie, I know you do a lot of transactional work. Are you seeing a lot of sort of forced sales as people anticipate if they hang on to these sort of businesses, they might be walking into, as we've seen here, potentially huge IHT liabilities that could be very damaging to the business?
Yeah, I don't think at this stage anyone feels forced, but certainly in discussions with clients where they've been thinking, should I transition this business to my children, or should I sell it and give them the cash? Definitely the discussion now is, I don't want to put that inheritance tax burden onto my children. And if I was 50-50 before towards selling or passing to my children, I'm much more likely to sell now. And for me, that's a really negative result for clients who are going to effectively sell things to third parties, to investors, perhaps to foreign buyers, rather than keeping those assets held within families.
Okay, Ryan, did you want to add anything on that?
No, I think we've covered everything there.
Okay, all good. Okay, so I think you've scared us suitably there, Ryan. Thank you very much. Let's start thinking about some of the planning we might do and the timings, etc., etc. I think back to you on this, Susie.
Yeah, so this, I think, to be honest, Ryan's example really neatly covers this. Effectively, just to be super clear, that if you die now, up to the 6th of April, you are still in the current rules. So in some senses,
it's not generally a good planning point, though, is it?
No, I know. I'm just making the point
Right.
that it would be, if you were going to die either on the 5th of April or the 6th of April 26, then better on the 5th, frankly. So up to that date, the old rules apply. From the 6th of April, the new rules apply. There are transitional provisions, though, and they really affect potentially exempt transfers. So, as well as trusts, which Ryan will talk about. So, basically, from the date of the budget, so from the date of the 30th of October, pets that were made after that, the new rules apply to those pets. So if you made a pet before the 30th of October, the old rules applied. So the business property relief rules applied then. From the 30th of October 2024, if you were to die, within 7 years, the new rules would apply if you died after the 6th of April. Like with all inheritance tax at the moment, and who knows what the future holds, if you live for 7 years, if you've made a potentially exempt transfer, then it's fine that you don't qualify for business property relief because it's outside your estate if you survive 7 years. There is a taper relief if you die between 3 and 7 years after making a gift. That, as far as we're aware, continues to exist unless anything changed in the budget. The £1 million allowance refreshes every 7 years, which is quite difficult to get your head around, but effectively that means that you could, really it's interesting in relation to trusts, but it means that every 7 years you get a new £1 million allowance. So just to be clear, that would mean if you were to die, you made a gift of £1 million of business property relief, or a chargeable transfer of £1 million of business property relief, and you died 8 years later, you would have another £1 million on your death. And as it says on the slide, the donee is liable to pay the IHT and can pay in instalments provided they still own the asset. So it's probably useful then just to reflect on what that means for us. What does it mean for people, like lots of my clients who own businesses? And I think it's fair to say it's a big mindset shift for those people. We've gone from talking to people who had completely exempt assets from inheritance tax, who really didn't need to worry about inheritance tax on their privately owned company shares, to frankly being really quite worried about it now. So the almost business property relief assets, even though the rate is lower above $1 million, have kind of fallen into the same category as other assets. Really, we really need to think about them and plan carefully. People used to structure their wills, for example, where they left their business property relief directly to their children and their other assets to their spouse, because the business property relief would go to their children free of inheritance tax, and then all things that would have been chargeable to inheritance tax they would leave to their spouse. People with those wills now need to look really carefully at them, think carefully. So there's a big thought process around wills. How you hold assets with your spouse. As I said, often you would leave assets directly to your children. We need to think now about business ownerships, because as I think Ryan said quite clearly, your spouse doesn't get at the moment, if you were to die at the moment and you didn't use your nil rate band for inheritance tax purposes, it would pass your spouse. That doesn't exist here with this £1 million business property relief allowance. And that means that if I, for example, were to hold an asset that qualified for business property relief, and I were to die, on my, without holding it jointly with my husband, I would only get £1 million allowance. Whereas if my husband was to hold 50% of that business as well, we would get a £2 million allowance. So where previously we may have been slightly relaxed about who held business assets now, and we would think more about the will, now you need to think really carefully. Do I want to own this jointly with my spouse to get the 2 million? Insurance.
So I was going to say, Susie, this is not deathbed planning, is it? Because
No.
you've got to hold the assets for 2 years, haven't you, to get your BPR?
Not if they're transferred from your spouse if you die, but it's a nuanced point, but yes, to put into trust.
Right,
so
okay, well, we'll come on to trust.
We'll come on to trust, So insurance, lots of our clients obviously insure against inheritance tax. They will have been super sensible, and they will have worked out what their inheritance tax liability is, and they will have got insurance for that, and hopefully they will have got that when they're younger, and therefore it's more cost efficient. For lots of those clients now, actually their insurance, they're going to have to get more insurance to cover this business property relief. So thinking about insurance, thinking now about doing things that lots of people don't want to do, which is actually giving assets away earlier, including interest in businesses. Because if you were to give a business asset if you were to give your business to your children to 5-7 years, it would be outside the scope of inheritance tax anyway. It's not as straightforward as it sounds, because if you give away a capital asset, it's a disposal for capital gains tax rules. So you've got another tax to think about. I've made a disposal. Have I got a capital gains tax charge?
We're doomed, aren't we here, Susie? Yes, but you're
We're not
quite
doomed.
right.
No. And the point is, there's lots of reliefs, there's lots of complexity. So the point to me is that everybody's position is a little bit different. And so it's really important to think about what your position is and how you can mitigate IHT.
Yeah. I mean, I guess the serious point, isn't it? For trading businesses, there's a lot more we can do, because we can hold over the gains for CGT purposes. So potentially that does give us a route here. But particularly where you've got, property investment businesses, it's a lot more difficult, subject, I think, to what Ryan's about to talk about with trusts, etc., whether that can give us another avenue into this. But I think I hear you loud and clear. We've got to think about all of this stuff now, whereas in the past it wasn't such a problem.
I think that's right. But importantly, the rules for what is trading, a trading business to get this relief that you've just mentioned for capital gains tax is different to the inheritance tax relief. So there's a plethora of different rules to think about, but you're quite right. Generally, the rule is if it's a trading business and there are very few non-trading assets or activities in that business, it's much easier. So, yeah. Just to mention use of holding companies, family investment companies, definitely we're seeing lots of clients thinking about, do they want to try and diversify in holdings through different holding structures? And then Ryan is obviously going to go into the wonderful world of trusts. So consider whether or not we want to put in assets into trust now, particularly before the changes.
Okay, Ryan was very politely sat there with his hand up during that slide. Ryan, was there something you wanted to add on that?
I will only add something on the, I know Susie covered most of it on the wills, but as I say, a lot of wills do say that any assets qualify for business property relief will go to my children. These assets still qualify for business property relief. So actually on death, those assets will still go to the children unless you consider rewriting the wills, which will create inheritance tax implications. Yes, the deeds of variations can be done and such like that, but you may want to consider rewriting wills where you have got business property mentioned in your will and making sure it is still efficient for what you need it for.
Okay, so revisiting and looking at wills, I think, is the important point there.
Yeah.
Okay, right. Strap yourselves in, everyone, because Ryan is now going to talk about trusts. Okay, Ryan, how can trusts help?
Yeah, so I'm going to split trusts into two categories for this purpose. So you're going to have a pre-commencement trust. So these were trusts that were already in existence before the 30th of October. So if you had a trust that was already in existence at that date, each single settlement will get a £1 million allowance, provided they meet the conditions. So one of those conditions is it must have had an amount, and I've put in commas there the bracket, sorry, the amount, because that's how the legislation defines it, is an amount of qualifying assets on the 29th of October 24. So from reading that, if it's got £1 of business property qualifying assets at that date, that trust would always qualify for a £1 million allowance for business property relief going forward. Now that may change it in the subsequent drafts of the legislation, but as we stand, that is what it states in the legislation. If you've got one of these trusts, which does qualify for business property relief, you shouldn't be adding anything to that trust. I would keep that trust as a separate trust, and if you want to look at other trusts, you can then in the future set up a different trust, but I would not be adding anything to these trusts. without certainly taking tax advice on what the implications would be of doing it.
Okay.
So if you have got a trust that qualifies, say it had a few £1,000s of qualifying assets on the 30th of October, then you could actually use that trust to buy additional BPR qualifying assets to up to the £1 million allowance. So that can definitely be used as planning if you're looking at 10-year anniversary charges coming up. You may want to consider diversifying into assets that qualify for it. Obviously, because there's other implications of doing that, but that is certainly one of the planning options available. And then you've got the post-commencement trust, the trust set up on or after the 30th of October. So they will have a maximum of a £1 million allowance, which is shared amongst all settlements created by the same settler, based on the qualifying value and order of settlement. So what that means is if you put £1 million of business property qualifying assets into one trust now, then in, say, 10, 15 years, you do another £1 million into another trust. That second trust will not get any business property relief available. That won't get that £1 million allowance. It will still qualify for business property relief, but it won't get that £1 million allowance. So the whole amount will be subject to IHT. Of course, if you put £500,000 in now in this one trust, and then in future settle another 500,000, both those trusts would get 500,000 of business property relief allowance. So the allowance is capped at the value of the qualifying assets settled. So that needs to be considered as well, because if you've got putting shares into a trust which are going to grow in value, so if you put £100 of shares in which subsequently increased to 1 million in value, that trust will only get £100 of allowance. That's all that can ever be claimed. So again, planning on what you're putting into trust, what value you're attributing to them, is important, because it's going to affect how the trust is treated going forward in the future.
So if I understand you correctly, Ryan, there's not much point if I have a startup that I think is going to be worth £1 billion in the future, putting those shares into trust isn't going to be particularly IHT effective, because I think you're saying the amount of protection is only the value of the company at the time I settle that into trust, isn't it?
That's it. So you might be better off waiting until you do get a bit of growth in that business, and then settling £1 million worth of shares in that business. That might be a better option than putting £100 of shares now.
Okay. So, Ryan, what sort of clients should be thinking about the use of trusts? Is there a sort of minimum value? Because obviously you've got to maintain a trust going forward. There are costs associated with that. You know, when do we sort of start seriously thinking about trusts, and in what circumstances?
Yeah, it's always a good question of when you've start putting assets into trust. Yes, there's going to be administration costs, especially if you're using professional fiduciaries. I do a lot of work with UK and international fiduciaries, and there is certainly associated costs for them. And certainly a lot of the fiduciaries I speak with wouldn't look at a trust below a certain value. But if you're dealing with it yourself, maybe you've got your family or yourself acting as a trustee, then it really comes down to the tax position. So you can save 20% tax of inheritance tax on it, then that actually brings down the value of what you need to put into a trust down quite a bit, because you still got to deal with the annual fees of maintaining the trust. But if you're going to potentially save a 20% tax on the value of the assets on your death, then that can be very attractive. And again, it's not going to be suitable for everyone, but if you are thinking about it, please do get in touch and we can actually run through some numbers with you, so you've got an idea of what the trust is going to cost you to maintain and what the potential benefit of having the trust is. But trusts are not just there for tax purposes. They haven't been fantastic for tax purposes for a while. They're great for asset protection, especially if you've got you're thinking of how you're going to pass shares down to the next generation. You're worried about what they might do with the assets or with the value. Trusts can be great for that actual asset protection as well.
Okay, go on, Susie. I think wants to add a few points here.
Yeah, I was just going to say previously I think I've used trusts much more commonly when people are exiting businesses, and they have been in a position where they might say, for example, we're selling the business for 10 million. I want to put £2 million into trust for my children, or £5 million into trust for my children. Not, as Ryan says, to avoid any tax, really, just to put that amount of money into a safe place where the trustees decide when and how the children or even grandchildren get those assets. So for us, that was really common planning for people selling businesses. We're putting value into trust before they sold. what clients have now is a much more difficult issue, which is that if they want to put £5 million of business property into trust, so 50% of their business, they can't do that post 6th of April. They can only put £1 million in without having a massive sort of inheritance tax charge. The difficulty people have now is if they're not about to immediately sell their business, how much value do they want to put into trust, and therefore how much of their business are they willing to settle into trust? So lots of the discussions at the moment are around, I want to put some value into trust, but I'm not actually sure how much my business is going to exit for, and therefore how much do I need and how much do I need to put into trust for my children. So I think people are in a much more difficult position now as regards to making a decision before the 6th of April, and it's important to talk about that, think about the different sort of iterations of how that might look for people.
Yeah, look, I think we're saying there's no one-size-fits-all solution to any of this, is there? And it needs very careful planning because, as Ryan's alluded to, there are costs in running a trust, and we also, I think, just moving on, there's also these darn 10-year charges, etc. we need to think about, Ryan, aren't there? Just before you explain that, just one other question from me, and I say this as someone who doesn't deal with trusts on a day-to-day basis. We've not mentioned onshore or offshore trusts. That used to be very relevant. Has that conversation largely gone away now?
There's very limited sort of benefit in setting up an offshore trust if you are UK domiciled, you're UK resident, all your tax affairs are in the UK. There's going to be very little actually tax benefit of setting it up. If you're not long-term resident, then there may be sort of advantages of doing that. Again, BPR qualifies on worldwide assets, so you may be able to settle assets into your non-UK assets into a trust that might be beneficial. Again, it depends on what you are planning to do. Are you planning on staying in the UK, being long-term resident? Then there may be little benefit in setting up a non-UK trust. But if you are mobile and you are only going to be in the UK for a few years, or you may be planning on leaving in the future, then there may be benefits of doing it. But again, there are tax implications of having a trust offshore if you're a UK resident. So again, please do let us know on that one if you do need advice on that specifically. It is an area I cover extensively, so please do get in touch with me. Okay.
All right, Ryan, talk us through a few other points here.
Yeah, so again, how sort of trust can help. So instead of a 20% charge on death, you can have a 3% charge every 10 years. The idea of that is that over average lifespan that you would still pay the same amount of IHT. So this is a change from a 6% charge you normally get every 10 years on a trust down to a 3% charge for business property qualifying assets. So it's an effective charge of 0.3% every year, which is much more manageable than a tax on death. Again, that can be planned against. You know you can have a charge every 10 years. Trustees can look at accumulating funds to make sure they've got the money to pay that. Again, it can be paid over 10 years interest free. So that's another point on that. The £1 million allowance refreshes every 7 years for transfers into trust. So you can settle £1 million into trust today, business property assets, and then in 7 years you can do it again without incurring an IHT charge. Of course, that second trust will not get the £1 million allowance itself, but it means you can get £1 million of business property assets out of your estate. The £1 million allowance is used up by capital distributions, but then it refreshes every 10 years. So this gets where it gets a bit complex in the actual legislation of how IHT charges work for trusts. But what we're saying there is if you've got £1 million now of business property assets sits in the trust, you transfer out 500,000 of them, of 200,000 I put there to a beneficiary. Then at the next 10-year anniversary, the trust will only get 800,000 of BPR allowance. But then that refreshes at the 10-year anniversary, so then it will get another £1 million allowance for the next 10-year anniversary. It's capped at £1 million, but it will get another. So again, you can transfer out another 500,000 after the 10-year anniversary without incurring any IHT on it. But then the following 10-year anniversary, it's only a £500,000 allowance. If there is BPR capital distributed of 1 million more, there will be no allowance for future capital distribution before the next 10-year anniversary. So again, in terms of planning, if you wanted to make multiple distributions, you need to be considering that, because if you use up your £1 million allowance straight away, then any future distributions are going to incur an IHT charge on that. So for pre-commencement trusts, these will be brought into the new regime from the next 10-year anniversary. So if you've got one of these pre-commencement trusts, you can distribute BPR assets out without incurring any IHT charge up until the next 10-year anniversary. So potentially, if you've got one that was just settled just before October 24, you've got until 2034 before the new rules kick in for that trust. But if you've set one up now, then it's not going to apply to that. So the 10-year charge will be based on a combination of the old and new rules then. So again, it's a bit of a mixed calculation. So it's going to complicate the IHT 10-year anniversary charges a little bit more.
It's tricky stuff, I think it'd be fair to say, Ryan, and seek advice, I think, is the best thing we can suggest there, but that's just a very brief summary. Okay, that's trusts then. Susie, any other business?
Yeah, so super quickly, I think we've picked up on a lot of these points. One of those points is that assets that you hold personally that you use in your business will only qualify for 50% BPR. It's often good to think about, do I want to put these assets into the business? So some thought there, that's just wider business property relief planning. Valuation of business property is going to be increasingly important. I talked a little bit about how much value to put into trust, but generally how much is business property relief worth in your estate? That will be important if you're thinking about trusts. But HMRC look at this and we should think about, or we should be cognizant of minority discounts. If you don't own 100% of the business and you own, say, 40, then it will have both a minority discount applied. We've talked, I think, quite a lot about wills. We need to think really carefully about wills. People should be revisiting their wills. I mean, regularly anyway, but particularly if they've got business property relief in there. It says here, don't leave planning and transferring into trust until the last minute, which is almost certainly true. This is not something you want to be doing on the 30th of March. The challenge, of course, that we always have is that we haven't got the legislation, so we don't actually know what the final legislation is going to say. But it's impossible for us to know when that's coming out, and therefore I think people need to plan based on the draft legislation, cognizant of the fact that things might change. We probably don't expect things to get much better in the tax world at the moment. So, yeah.
Fair enough. And I think, again, we've covered a lot of these points, but all right, just to cover off the top one, now is the time, really, isn't it, to think about if you have significant assets, wills, IHT planning, trusts, etc. Don't just put it off. Whereas in the good old days, you could probably say, well, BPR will probably bail me out. God forbid I get hit by the number 38 bus on the way home. We need to think about holistic. I used that word, Susie, didn't I? We promised we wouldn't use that, but you do need to think about this sooner rather than later. Fair point? Yeah,
it is. There's just one other point on there about international aspects, and it's probably just important just to flag conceptually a change to inheritance tax now. And I think Ryan mentioned it's based on long-term residence, which is a concept that I'm not going to go into, but it's not domicile anymore. It used to be the case that you were UK domiciled, you were subject to inheritance tax on your worldwide estate. That's changed now, so it's actually about long-term residence. So in theory, even if you're born and bred in Britain, you live here all your life, you could leave, and to provide you spend sufficient time outside the UK, read more than 10 years, you won't be in the scope of UK inheritance tax on your worldwide estate anymore, just your UK assets. So there are lots of people, and we're not encouraging people to do this, we want people to stay in the UK, but people are thinking more widely about inheritance tax and where they live, because it is now a bit easier to get outside the scope of UK HT.
All right, Ryan, did you want to add something to that?
I'm just going to add on the trust bit about not leaving it to last minute, because again, we might not get the legislation until late, but one option with that is you can set up what's called a pilot trust, where you set up a trust with a nominal amount, because that's what takes the time. It's getting the terms of the trust right, getting all of the deeds set up and signed. So you can do that, have £10 sat in a trust, and then if you want to press the go button during March, then it's a lot easier to transfer shares into an existing trust than creating a new trust at that time with the shares already in it. So that might be something you also want to consider.
Okay, fair point. Thank you, Ryan. And there's just a couple of other points there that, again, we've touched upon. So just to mention, of course, think about all the standard lifetime planning, be it gifts to children, spousal planning. If you have a spouse, that gives you the possibility of passing assets between the two of you without IHT. And we did mention insurance, didn't we? Which I think is going to be more and more relevant. And I think, Ryan, you covered off BPR to start with and the general conditions. I think, Susie, actually, you mentioned accepted assets. So do be careful. And as someone who doesn't do IHT day to day, I think my sort of takeaway is it is very subjective, this point about accepted assets, isn't it? Particularly where you've got cash in a business. Is it used for the business? In fact, I think it was you, Ryan, who made the point. You need a clear business case and a plan to show that that cash is truly needed, rather than just we've put it away for a rainy day. But I think the key message is now is the time to think about these things, think about your planning, and do talk to us. Ryan, Susie, and the rest of the Trust and Estates team here would be delighted to talk through your particular circumstances and see how we can help. And then, okay, it's a year further back, then we need to start thinking about IHT on your pensions as well, just to add to the mix. So it is constantly changing. We do have a budget coming up next month. Are we expecting any changes to this draft legislation, either of you? Anything that's been picked up? Ryan, any thoughts? Where would your smart money be if there to be any tweaks here?
Well, I can't see anything changing during the budget. I think the application of the rules might be what comes through the relevant sort of read-in stages, especially when we talk about the value of BPR for each individual trust, or how the rules work on potentially exempt transfers. There has been talk about increasing the time from 7 to 10 years for potentially exempt transfers. But yeah, other than that, I can't see it getting better. They may hopefully relax the rules a bit on APR. That is my hope, but I'm not sure it's going to go that way. But that's probably my own personal bias on that one.
Susie, do you see any other sort of more general changes to IHT or perhaps CGT? The two do interact here.
I'm going to say, Tony, I've never ever been right on a budget prediction, but I think CGT, unfortunately, as it's my it's a tax I see a lot, but I worry about CGT this year. I worry about going up to the old days of 28%, to be honest. So I have a bit of concern about CGT. That's my terror, but I'm always wrong, so I'm saying it in the hope that I'm stopping that.
You heard it here first. CGT is going up to 28%. There you go. We shall see, but we will be doing a webinar on the budget. So hopefully you can all join us for that. And that's about it on these BPR changes. Not a lot of good news there. We do children's parties if anyone would like us to join them for that. But sorry to share what is a difficult issue, albeit hopefully we've highlighted some of the planning points that are available. So that's it from me, from Ryan, and from Susie.
Time for a couple of questions. Do you think? I see there's a few questions there.
Oh, sorry, I must have missed those. Go on, fire away, Ryan. You take them away.
I've seen the two of the questions there. So we've got one question. How about the pre-2006 IIP that hold a mixture of APR, BPR, and non-relief? So if you've got a pre-2006 qualifying interest in possession, then it's treated as you owning it personally. So the £1 million relief will be shared between you and the trust asset. It be probably apportioned. Again, there wasn't a lot in the legislation about that, but it would be probably a portion similar how we would with the nil rate band, where the trustees get a part of the nil rate band and the personal estate gets part of the nil rate band. And the other one, can you still transfer farmland into a discretionary trust without any CLT charges if done before April? So if you transfer farmland into a discretionary trust, there is a chargeable lifetime transfer. But yes, if you do it before the 6th of April, then you've got to, as long as you survive the 7 years, then there'll be no charge. Or if you don't survive the 7 years, then it's just the £1 million allowance on that value. So yes, it can be done, but again, you may want to consider taking out insurance just to make sure it's covered that. And again, with farmland, please consider development value of that, because that does not qualify for APR.
Okay, right. Thank you for that, Ryan. And thank you to all of you for joining us today. We will be sending both a copy of the slides and a link to the recording of this that will be uploaded onto our website very soon. Thank you to Maz, Lola, and David in the background, who do all the hard work. We just turn up 5 minutes beforehand, don't we? It's easy for us, but they're the guys who pull all this together. So thank you to all of them. And we very much hope you'll be able to join us next month, it is, for the next exciting budget update. So we hope to see you then. In the meantime, if you've any questions on anything we've covered today, or listen, we're here for we love any questions, don't we, Susie? We'll do it all. We'll do it all. Anything on tax, you've got our contact details there, and we look forward to hearing from you. But for now, thank you very much and goodbye.